Imagine predicting the exact macro trajectory of an asset for an entire decade. You spot the pattern, you know exactly where the market is heading, and you nail the long-term trend with absolute perfection. But even with a flawless prediction of where the price will end up, your trading account is completely wiped out. You are perfectly right, but practically ruined. This agonizing scenario is exactly what happens to most people who try to trade gold. Knowing the final destination of an asset means nothing if you can't survive the execution path. The daily turbulence will break your account long before the easy money ever arrives. If you pull up a monthly chart of gold against the US dollar, it looks like it wants to climb higher forever. The baseline truth is that gold favors momentum. It has a natural upward drift that acts almost like gravity. This chart illustrates a multi-year upward trend. A massive quantitative study recently proved that if you enter trades by literally throwing darts at a board, buying at completely random times, filtered only by a daily uptrend rule, you would be profitable. That completely random entry system produced a profit factor of 1.50, returning $1.50 for every dollar risked, just by harvesting that natural upward drift. That reliable upward drift is exactly what traps retail traders and online gurus. They see this background gravity, build a simple long-only trend system, and assume the market will do the heavy lifting for them. On paper, looking at a beautifully smooth macro chart, it looks incredibly easy. But as the author of this quantitative study noted, the most dangerous words in trading are, "it should work." A mathematical tendency for an asset to drift upward does not translate into a tradable rule. The background gravity is real, but it is true enough to build a wildly false conclusion on top of. To see how that assumption breaks down in practice, we have to transition from those smooth monthly charts to the grueling reality of trading hour by hour. This data comes from a rigorous, decade-long study spanning from January 2016 to June 2026. The author analyzed 64,172 hourly data points. They specifically used ultra-precise mid-price data from the broker Dukascopy to ensure the backtesting wasn't skewed by liquidity drying up or artificial spread manipulation. They tested 5 different fully sampled mechanical trend models against this pristine data. Out of those 5 models, 0 beat the random dart-throwing baseline. In fact, a staggering 87% of the trades were stopped out before the trend ever paid out. This chart demonstrates what happens on the granular level. Even when using a historically generous 1.5 average true range stop loss to give the trade plenty of room to breathe, the price violently pierced that protective boundary over and over again before marching higher. This vertical distance between your entry point and the deepest negative spike before the upward trend resumes is known as adverse heat. Over half the time, the market inflicted more than 1.5 ATR of adverse heat, forcing you to bleed out deep into your account before rocketing to the target without you. You are getting stopped out repeatedly, but not because your directional thesis is incorrect. Your protective measures fail because those boundaries sit completely inside gold's normal, everyday noise. Markets do not move in clean lines because the fuel that moves price, liquidity, doesn't sit in clean lines. Large institutional players and algorithmic systems actively engineer these jagged spikes. They engage in liquidity hunting. These predatory algorithms deliberately drive prices directly into the obvious technical levels where everyday retail traders cluster their protective stops. They grab that liquidity to fill large orders and then reverse to make the real move. If 87% of trades are getting stopped out, how do trend-following systems maintain their legendary, almost mythical reputation for printing money? This 10-year timeline reveals the answer. From 2016 to 2022, and again in early 2026, the trend strategies bled out a devastating negative 52 units of risk. The entirety of the system's profit came from a single anomalous window between 2023 and 2025. During those 3 specific years, record-level price-insensitive buying from global central banks stepped in. That massive accumulation temporarily overrode the standard intraday noise, physically absorbing the liquidity hunts and making the follow-through incredibly clean. Mistaking that 3-year window for a permanent mathematical edge is what the author calls the era concentration trap. You assume an abnormal temporary regime is a permanent structural reality, and you bet blindly on a lucky streak that is mathematically guaranteed to end. To combat these illusions, the author of this study built a permanent open-source data room. They uploaded all 64,000 raw data files and timestamped every single trade to force absolute transparency, stripping away the marketing claims to expose the frictional reality of the market. You don't need to run a massive Python script to verify their claims. The author invites you to use the eyeball path challenge to measure the pain for yourself. This is a standard 1-hour gold chart. Pull one up on your own screen, find the last 10 clean breakouts to new highs, and take a drawing tool to measure the adverse excursion. Don't ask if the trade eventually went higher. Manually measure exactly how far it dug against you first before it finally paid out. You will see with your own eyes that the drawdowns repeatedly blow past where any sane person would place a stop loss. To survive, you must stop staring at the promised destination and start measuring the actual heat. When you build any system, the execution path matters infinitely more than the final destination. A macro trend can be mathematically proven and universally accepted, yet it will still bankrupt you if you ignore the daily frictional cost required to ride it. And this brutal reality applies far beyond financial markets. Think about your career trajectory, your relationships, or your long-term personal goals. You might be absolutely certain of where you want to end up, but are you betting so heavily on that obvious destination that the volatile, agonizing path will shake you out before you ever arrive?